Hello, this is a discussion about problem 4-20, Allen Community Hospital. In this problem, they've given us all of the ratios already calculated. As you can see on the screen, here's the ratios and here are the formulas. I have put in the benchmarks, which you can find in Exhibit 4.16a, Financial Ratios for All U.S. Hospitals by Bed Size. So the problem tells us that Allen Hospital is in the category of 1 to 99 beds. I believe it's 95 beds, and so we use the benchmarks from that table. Looking at the current ratio, so what does the current ratio tell us? Why do we do the current ratio? So as we discussed, the current ratio tells us how likely we are to be able to pay our current liabilities. So it calculates our current assets divided by our current liabilities. So if you were 2 to 1, that means you have double the current assets to your liabilities. So here we want to be above the benchmark, as it states in Exhibit 4.16. And so if I were to describe this, for example, we would say that Allen Community Hospital in year 2000 was at the benchmark of 2.18 in terms of the current ratio, but they were trending unfavorably, as in 2001 they went below the benchmark of 2.18. And so what does this tell us? This tells us really that while they may have a problem compared to the benchmark in paying their current liabilities. Remember that just looking at one ratio does not, we don't want to conclude something. We want to look at ratios in totality. So then we move on to the acid test ratio, which is similar to the current ratio, but it takes out accounts receivable and other types of current assets. It only looks at cash and marketable securities divided by current liabilities. Here, our benchmark is 0.35, and again, for year 2000, we are at the benchmark, and in year 2001, we are below the benchmark. And here the desired position again is above, and so we would conclude here that based on the current ratio and the acid test ratio, there could be a potential liquidity problem. Next is days in accounts receivable. This tells us how long it takes us to convert our receivable amount owed to us into cash. So the benchmark here is 47 days, and we want to be below that benchmark, right? Think about it. Would you rather get paid in 47 days or 63 days? I would want to be paid in 47 days. So here we can say that Allen Community Hospital has a problem collecting their receivables or turning their receivables into cash, and in year 2000 they were well above the benchmark at 63 days, but they've shown dramatic improvement down to 53 days, so they are now only 5 days above the benchmark, so they've done some good work there. Next we look at cash or days cash on hand. The thing to remember here when you're doing your calculation is that we always include cash plus marketable securities plus long-term investments or board designated funds. So board designated funds in many of your entities, nonprofit entities, we'll call their investments board designated funds. So in this one, think about it. Would you rather have more cash on hand or less cash on hand? Obviously you'd want more. And so here you want to be above the benchmark. Our benchmark is 85 days, and here in year 2000 they were at 90 days above the benchmark. Looks good. But then in year 2001 they went down to 70 days, which is below the benchmark, and so we have more concern here based on the days cash on hand. Next we'll look at how long does it take them to pay their bills, the average payment period, and here we want to be below the benchmark, right? We want to show that we pay our bills sooner than later, and here we were in year 2000 5 days above the benchmark, so it took us a little bit longer, but really in 2001 we trended really poorly at 75 days, 30 days above the benchmark. So next, let's go on to our revenue, expense, and profitability ratios. Here we're looking at specific revenue and expense items. So here we're looking at revenue per adjusted discharge. What does this tell us? So if we look at what's our total operating revenue divided by total discharges, it gives you the average, or what we collected based on each discharge. A discharge, remember, is each patient who's an inpatient comes in, they're admitted, and then they're discharged. So it looks at the number of patients who were inpatient. And here, if you look at our benchmark is $7,086. Which would you rather get paid? $6,500 per procedure, or would you rather get paid $7,086? So of course you'd rather get paid higher. So our benchmark here, we would want to be above the benchmark. So talking this one through, so our benchmark is $7,086. In year 2000, we were $586 below the benchmark at $6,500. We've improved in year 2001 to $6,900, but we're still below the benchmark. Opposite of our revenue is our expenses. So here, would we want our expenses to be higher or below the benchmark? So I hope you're thinking you would want to be below, right? So if you're producing something, you want your cost to be lower. So here we want to be below. And here we can see that not only are our expenses higher than the benchmark in year 2000, they got even greater or more or higher than the prior year. And so we're trending unfavorably. Here we were favorably trending, and here we're unfavorably trending. Next, we look at the percentage of salary and benefits as a percentage of operating expenses. So this is what we would call vertical analysis versus horizontal, because vertical we're looking at one line item as compared to the total. And we talked about this, that one of the highest expense in most healthcare institutions are our people, right? Our nurses, our administrative people, us, and so forth. So here the benchmark says that 40% of your salary and benefits were spent, or 40% of your total operating expenses were salary and benefits. And here at Allen, we were 45%, and then we trended unfavorably to 50%. So we were unfavorable to the benchmark in year 2000 and continued to be unfavorable now at 50%. Operating margin is an item that we always look at. Our operating income divided by our total operating revenues. So remember, our operating income is like our net income, and our operating revenues is our total revenues. So here the benchmark is 2%. Remember, we're always going to talk about operating margin in terms of percent. So you move this decimal point over 2 spaces to get the percent, 2%. So we were at -1%, that's what the brackets here indicate, and we want to be at 2%, so we were unfavorable to the margin. And here we had somewhat of a turnaround in that we are now +1%. We're going to move now to our activity ratios, and the one we're going to focus on for our discussion here is age of plant. This tells us how old is our equipment. And if you were going into a hospital, would you want a new MRI to do your MRI, or would you like an ancient one? So I think we all would want a new one, right? And so here the calculation is pretty simple. You take accumulated depreciation divided by depreciation expense. And the benchmark is 10.41. And we talked about you'd rather have newer equipment, right? So you would want to be below. And here they were significantly, or they were about 1.1 above, 1.11 above, and they now dip below. So how do you think they dip below? Well, they dip below by buying new equipment. Which brings us to our next one, our capital structure. And here, let's look at the long-term debt to equity ratio. And on this one, we want to be below the benchmark. And here we are 0.18, and then is the benchmark, and we're at 1.4, and we grow to 1.47. So this to me indicates there's a serious problem with their capital structure and that they owe a lot more money, and so I'm not sure I would loan them any money. So let's look at the next ratio, which is equity to total assets. So here, if we look at that, do we want to be above or below the benchmark? So here I would say we want to be above the benchmark. Our net assets is our equity section divided by our total assets. And here we can see we are below. And here our debt service coverage ratio, we want to be above. And again, we are below. So related to whether we have the potential to borrow money, I would say they do not, because their capital structure ratios are opposite of the benchmark and trending even worse in most cases. So let's summarize on Allen Community Hospital. Our liquidity that we talked about in the beginning was weak, and they were in a declining position. All of their ratios, the asset test, the current, as well as days cash on hand, all decreased into unfavorable positions from year 2000 to 2001 and are below the industry standard. We also talked about that they're not paying their bills on time, and so that adds to greater current liabilities. The one positive thing was that they reduced their days in accounts receivable by 10 days down to 53, but they are still above the benchmark of 47. We spoke about the revenue, expense, and profitability, that although their revenue increased, their expenses increased as well, and they need to look at either increasing their patient volume or negotiating higher payment rates to increase patient revenue. The operating expenses per adjusted discharge is what we spoke about, right? They were over the benchmark, and I believe they were trending negatively here. We looked at the age of plant, and we thought, this is good. This is the one area where they are doing well, that they're using their assets efficiently, and the average age of plant is below the benchmark. And we also talked about their capital structure that's problematic in that their long-term debt to equity increased, indicating they probably had issued some debt to purchase the new assets, and that they are far above the industry benchmark, suggesting a highly leveraged position, meaning that they owe a lot of money. So overall, it appears that Allen has recently borrowed money to buy equipment and upgrade their infrastructure. They are not in a good position to borrow money in the future, and they don't seem to be improving their net income, improving their revenue and expenses. They need to lower their operating costs, like their salaries, and improve their operating margin. They have improved from year 2000 to 2001, but they still are not at the benchmark. So that's really how we look at these ratios and we interpret them.